what's an exit tax and who's liable to pay the exit tax. Lately, Manasa and I have been getting a very common question because of the conditions and what's happening here. And it goes something like this. I want to leave the US and simply cut ties and never have to worry about what's happening here. I want to move my money overseas. Okay, maybe not so fast, because you may have to pay an exit tax if you give up your citizenship and your green card. So today, we're going to tell you all about this. What's an exit tax? Who's liable for it? And at the end, we will give you some planning considerations.
Yes. So let's start with what is an exit tax? An exit tax is basically exactly what it is, what it says. You pay a tax when you want to expatriate or leave the country. There are many considerations that goes into who is subject to this, and how that is determined and how the tax is actually calculated. So let's break that down and let's first talk about who would be subject to an exit tax. So if you give up your US citizenship, whether you were a naturalized citizen or you were born in the US, it doesn't matter. Or this would also apply to you if you were a green card holder for 8 out of the last 15 years, right?
Right.
So Section 877 Cap A would apply to all of this that we are talking about today. So for an expatriate to be called a covered expatriate, the individual has to satisfy one of 3 tests. So remember, that's one of 3 tests. It's either the net worth test, which means that their worldwide net worth is $2 million or more on the date of expatriation, or the tax liability test, which means that that individual's average annual net income tax obligation for the 5 years prior to the date for which they're expatriating exceeds a certain amount, which for 2026 is 211,000, or the tax compliance test, where somebody has to certify, or maybe they fail to certify under penalties of perjury, that they have to certify that on a certain form, which is the 8854, that they have complied with all of their US federal tax obligations for those 5 years. So these are one of these 3 tests. If you come under any one of these, then you are what is called a covered expatriate, and you may be subject to exit tax.
Okay, so assuming you're now a covered expatriate, I'm curious, could you maybe just go briefly into how's the exit tax calculated?
Yeah. So this is not going to be a back of the envelope calculation, folks. Absolutely. You cannot just do that at all. Let's just give you a high level overview of things anyway, because we want you to be educated into, and expect what you need to know. So the actual calculation of the exit tax is based on the type of assets you have, whether they are tax deferred assets, whether they are deferred compensation, and where they are located, whether they are in the US or they are foreign. So even your foreign assets will be counted to calculate that $2 million. All of these things are taken into account, and different tax rates are applied to the different type of assets that you have. And all of this is calculated on a form 8854. Right now, there's a lot of things that are going on that are churning because of new final regulations that were published a few months ago. And this was Section 2801. And after many, many years, more than a decade of waiting for a new form, the IRS has finally published this new form, which is this Form 708, that is available for calculation of some gift taxes, etc. So there's a whole lot of things that are going on that are changing in this area. So if you're right now a person who's thinking, wait, did I hear this right? Maybe one of these tests apply to me. Or maybe I either have more than $2 million in assets, which is kind of not that difficult for people to have these days. I mean, with a good, healthy 401k, or you maybe the tax compliance test, or even you may have owed more than $211,000 in taxes. So if you think you're thinking of leaving the US, but you think that one of this would apply to you, please consult an attorney or a qualified cross-border tax expert to know if this exit tax would be applied to you and how that will be determined.
Manasa, one of the things I absolutely love when we do this is you've memorized all these forms and sections of the tax code, which is absolutely amazing to me and a really good thing. I'm very happy if I'm thinking of, oh, what's this form? You'll be able to tell me right away. So as we're thinking about all these different forms, one thing that now comes to mind based on everything you just said is there has to be some post-expatriation tax obligations, because we know the US just doesn't let you go off like
Oh,
that.
yeah.
So what are some of those considerations or tax obligations, even though we're assuming at this point you've given up your citizenship or your green card? What are some of those?
Good catch, Jane. Yes. So even if you leave the US, you pay the exit tax if you're subject to it. Unfortunately, you may continue to have US tax obligations in certain cases. One is, of course, you continue to have US source income. That's kind of almost understood, I guess. Like if you are leaving behind a rental property, let's say, or some brokerage accounts from which there'll be interest and dividends, US source income. Maybe you still have your retirement accounts here, in case for 3Bs, etc., which you do not take with you or you do not plan to, then those distributions will be subject to tax. And then another big one, gift and estate taxes, you could continue to be subject to that, which is a whole another episode, which we would love to come to another time. So those are some tax obligations you would continue to owe to the US government even after you exit.
Okay. So it sounds heavy for sure, and it is. So the way I'm looking at this is, we know there's all that you've talked about is you do have some planning considerations, right? Or some things we can do to plan for this. So
Of course.
one, I know the exit tax can be entirely avoided for covered expatriates, but you have to plan very, very carefully to potentially mitigate its impact. So timing of expatriation is going to be key, because when you expatriate, that's what determines, let's say, your net worth and your average annual net income tax liability. So this is not a decision you just wake up and say, I'm out of here. You really want to plan and time. You also want to consider your doing some asset transfers and gifting, because again, this will reduce your net worth and potentially, mitigate the exit tax impact on some assets. But it really needs to be executed way, way ahead in advance. Otherwise, there could be what they call anti-abuse rules. You also want to really think about your retirement account planning. You're going to be leaving your 401k, your 403b, your Roth IRA. And let's take into consideration the fact that you're about to become an NRI.
Hey, not an NRI, an
What?
NRA, because an
Shoot, I'm
NRI
sorry.
is a non-resident Indian.
I'm sorry. I think I have India on my mind. I just spoke to a client from India. Okay. Sorry. So NRA, right?
Yes,
Which
yes.
means non-resident alien, which means you're now still going to be obligated to pay, for example, on the case, something like a 30% tax when you take the money out. It also means your estate tax exemption is some really serious planning considerations in there. And then, of course, there's going to be, trust and estate planning. You may want to consider restructuring trust. You may want to decant, or rather take assets out of some of the trust. You may do what we call foreign domesticating foreign assets. So there's a whole lot of estate planning that you can do, again, to mitigate the exit tax impact on beneficial interest and really future distributions from some of these trusts. Can you think of any more?
Oh, definitely. There are also
Okay.
treaty considerations depending on where this person might end up going back to, and whether that country has a treaty with the US, whether if it is an income tax treaty or an estate tax treaty or a social security totalization agreement, and so on. So all of these will potentially impact the exit tax or may even eliminate it. We don't know until we know what country it is. And also valuation considerations. I mean, there is a lot of volatility in stocks and shares. And also, there might be reasons for, when you're considering trust and estate planning and asset transfers and gifting, there are planning opportunities for valuation because remember, the unrealized gains, there is an exclusion under this income tax of maybe about under $1 million at this point, which is adjusted to inflation. So it depends on when you expatriate. But these are planning considerations for sure, because if you know where you're going to, then take a treaty into consideration. And obviously, everything I just said about valuation, and also the fact that if you're going to be leaving behind assets here in the US, who your beneficiaries are going to be, and then, what have you put in place so that now under the new 2801 rules, will they be subject to tax again if you give those assets back to them, which will make more sense when we come to that. But that's what I would like to add here, just so people who are listening to this know that these are all of the things that go
Sure.
into what is an exit tax.
Okay, so we've told you what an exit tax is. We've also told you how to mitigate it and what
Mhm.
planning considerations we have, which I think is really the goal of our podcast, educate you on some of these things. And so with that, I think we're good to conclude.
Absolutely. Absolutely. Thank you so much, dear listener, for being with us today. And if you like our content, yes, please go to our website, the theimcafe.com, theimcafe.com. Of course, don't forget to check out our store. We have a very cutely named store and we have lots of goodies. And of course, we have a checklist that you can use to, look and check off things that you need to do if you're planning to exit the US. So go check out our store. And thanks again for listening. And we'll be back with more. Bye.
Bye.